Okay, hi there. Welcome to a video where we're going to be looking at the supposed rise of zombie firms in many advanced and emerging countries. Now, zombie firms, I think, is a really interesting topic to be aware of as we head into a key phase for the world economy as it moves out, staggers, if you like, out from the COVID pandemic. So what are zombie firms and why do they matter? Well, we need a definition of a zombie firm, and one is that it's a business that is deemed unable to cover the cost of meeting their existing interest payments on their debts, meeting them from current profits over an extended period. So another definition, if you like, another interpretation is that a zombie firm is unprofitable with a low stock market valuation, but typically these are unprofitable businesses that can't meet the interest on their debts. Now, some economists argue that the presence, the existence and the survival of zombie firms has increased markedly since the 1980s. This chart's quite interesting. It draws on research published by Banerjee and Hoffman in a 2020 paper published by the Bank for International Settlements. And they found that the share of zombie firms in public listed companies, that's companies listed on stock markets, has climbed from about 4% in the late 1980s to over 15, perhaps 17% in 2020. And so too is the probability of a firm, once it achieves a zombie status, remaining a zombie firm. Others argue that the issue is not as important, that zombie firms account for only a small percentage of total output and employment, typically because zombie firms tend to be smaller. So what are some of the characteristics that we observe of so-called zombie firms? Well, the Banerjee and Hoffman research is quite interesting, and I wanted to pick out 4 aspects that they think are key characteristics of these types of companies. The first is that these companies typically tend to be smaller. They're normally about 1/3 the size of non-zombie firms. They're not necessarily those huge corporate giants, many of which are now sort of household names. Secondly, they tend to be less dynamic. They tend to have less money, for example, to spend on capital investment and research and development, partly because they're having to use up so much of their money, their revenues, to cover the interest payments on debt. Zombie firms also tend to be less productive. They found that labour productivity, that's measured by something such as output per hour, tends to be about 1/2 of non-zombie peers in the same industry. And crucially, zombie firms tend to be more leveraged. Now, leverage is a term that we can get from business economics. It's where a company has a very high ratio of debt to assets. So zombie firms tend to borrow a lot of money, perhaps by issuing corporate bonds or by taking out bank loans. And that borrowing, that external finance, if you like, is used to get them through periodic cash flow problems. So why do zombie firms manage to survive? In fact, the evidence is that the median survival of zombie firms is around 7 years. Well, there are 3 potential explanations for that. One is that zombie firms just are able to get hold of external finance. They're able to borrow money to survive, particularly given that we've had a decade or more of very low interest rates. So corporations listed on the stock market can typically borrow money at a cheaper interest rate than non-listed smaller firms. That's a good example of a financial economy of scale. And if you can access the loans, you can essentially roll over their debts. You can roll over your debt, you can borrow more money to pay off the interest on the existing debt. Secondly, commercial banks, they may be reluctant to call in loans because they themselves are vulnerable to the financial costs of bad debts and loan defaults. It's the old adage that if you owe the bank £1, you're in trouble. If you owe the bank £1 billion, well, they're in trouble, particularly if you default on a loan. And I think point 3 is particularly relevant, especially given what's happened in the last couple of years, that zombie firms can survive because they can tap into, access government financial support, some form of state aid, for example, a state guaranteed loan. perhaps a loan made at a concessionary rate of interest. And of course, often they can tap into things like employment support schemes. In the UK's context, of course, we have the furlough scheme from the spring of 2020 onwards. So why do many zombie firms survive? Well, some do die, but others are taken over through merger and acquisition, and some eventually recover. But actually the key point from Banerjee and Hoffman's work is that relatively few zombie firms die through exiting the market. Well, why does having a sort of a cluster, if you like, a long tail or a lag of zombie firms, why does that matter for an economy? Why might it be a problem for the performance of an economy such as the United States or Japan or Germany or indeed the UK? I'm going to pick out again 4 key points. Firstly, the impact on productivity. The research shows that zombie companies typically have lower productivity, and if there are enough of them, that's going to hold back, limit productivity growth in the wider economy, which then has a consequence for long-run aggregate supply and therefore a country's trend growth rate. So if you like, a long tail of zombie-esque firms could hold back the growth rate of real GDP. Secondly, zombie companies typically are unprofitable, and therefore they might be paying employment taxes and things, but they pay little tax in the form of corporation tax, which is a tax on company profits. So that can have quite a sizable impact on the government's budget or fiscal deficit and level of national debt. And then thirdly, zombie firms can restrict the dynamism of markets. Often we say that the ins and outs of markets, some firms leaving, other firms joining, creates a dynamism. Schumpeter called it creative destruction. And the exit of firms creates possibilities for new suppliers, new challenger brands to emerge and enter and perhaps succeed. So having a lag of zombie firms can hold back the dynamism of a market. And they may soak up some of the financial capital available for businesses. And this can lead to something which we call crowding out. So if zombie firms are issuing corporate bonds or going to the financial markets to get extra loans, that might crowd out some of the financial capital available for new businesses. And in that sense, scarce financial capital can be misallocated, going to zombie firms instead of emerging firms. And economists would call that a loss of allocative efficiency. A new book by Agnion, Anatine and Brunel, The Power of Creative Destruction, argues that constant innovation is the driving force of capitalism and the catalyst of long-term growth. And the key aspect of this is that weak or zombie companies are allowed to go bust, freeing up resources for companies which will use them perhaps more efficiently and effectively. So zombie firms can hinder progress in achieving more dynamic efficiency, which in the longer term is important in building and sustaining international competitiveness. So you can make quite a strong argument for saying that zombie firms can hold back the growth potential of a country and ultimately its competitiveness. Well, I suppose this whole debate revolves a little bit about what a zombie firm is. If we're saying that zombie firms are unprofitable businesses with high levels of debt, then perhaps Tesla is a zombie firm, or Netflix, or Deliveroo. Would you count them as zombie firms? They're often perceived as being high-profile success stories with a huge amount of investor confidence. And in some sectors, such as pharmaceuticals, many research and development intensive businesses, many pharmaceutical companies are not profitable at a given moment in time and have high debts, perhaps because they've had to commit hundreds of millions of dollars ahead of time to research new drugs, new tests and things before perhaps winning a patent or delivering to the market a highly profitable drug. So one chart really to finish off with is to remind you that there is a huge amount of non-financial corporation debt in the world. This chart's quite staggering actually, that the level of existing debt, the debt of non-financial corporations across the world has grown significantly from just over $46 trillion in 2009, of course that was the year following the global financial crisis, to over $81 trillion US dollars towards the end of 2020. Chinese corporations have over $21 trillion of that debt, over a quarter. And you may well be following the travails of the Evergrande Chinese commercial property company, which is in deep trouble at the moment. So there is a huge amount of debt. And I think in 2022, with market interest rates likely to rise to help combat rising inflation, it may well be that many firms laden with debt will find it difficult to finance their way through the year. So my feeler is that we can expect the issue of zombie firms to remain one of growing interest to economists and policymakers alike in the next few years. Okay, well, thank you for joining in on this topic video on zombie firms.